What if I told you that while Wall Street analysts are upgrading ExxonMobil left and right, the real secret to winning with this stock has nothing to do with chasing upgrades? My name is Warren, and today I'm going to show you something that could change how you think about investing in ExxonMobil forever. I've been dollar cost averaging into Exxon for the past few weeks, and the results might surprise you. While everyone else is getting excited about analyst price targets and upgrade cycles, I discovered something that research shows is actually far more profitable. You will want to watch the whole video because we're about to dive deep into the data. Let me start by showing you exactly where I stand with my Exxon investment. As you can see on my screen, I've been methodically building my position over the past few weeks using a dollar cost averaging strategy. I currently own 50 shares of ExxonMobil at a weighted average cost of $10.72 per share. This represents a total investment of around $5,500. And as of today's closing price of around $115, I'm sitting on a total return of 4.25%. That's about $235 in unrealized gains. While that might not sound like much, what's important here is that I've been buying consistently regardless of daily price movements. My strategy has been to invest roughly $2,750 every few days, which has allowed me to capture different price points. You can see from my trading records that I made my first purchase on July 2nd at 10:09 and then again on July 7th at 11:35. This systematic approach has protected me from the volatility we've seen in energy stocks. Right now, I'm looking at my current budget allocation. I'm working with $5,000 monthly for this position. What we do on this channel is we use Perplexity, Seeking Alpha, and Morningstar to look for investments. We make videos on this, and I put my money to work. But I just don't sit there and let my investments go as is. I'm trying to find out what I should do. Should I continue with my strategy or should I change it? So today, and we're going to ask questions into Perplexity and analyze the situation with ExxonMobil. Now here's where things get really interesting, and it's something most investors completely miss. In the past 2 weeks, we've seen a flurry of analyst upgrades for Exxon. Piper Sandler alone raised their price target 3 times, from 125 to 131, then to 134. The stock popped 2.1% on the last upgrade. But here's what my research uncovered about analyst upgrades, and this is going to surprise you folks. I prompted Perplexity, and it analyzed over 66,000 analyst recommendations for S&P 500 companies. The data reveals a shocking truth about the buy the rumor, sell the news phenomenon. Stocks that have the strongest immediate reactions to upgrades, like ExxonMobil's 2.1% pop, actually underperform by 0.43% over the following 6 months. Meanwhile, stocks that barely react to upgrades outperform by 1.51% over the same period. This means the market has already priced in the upgrade optimism. What's even more revealing is that when you see multiple upgrades in a short time frame, like we've seen with Exxon, it often signals peak sentiment. The research shows that only 12% of analyst recommendation revisions can be deemed significant market events. The rest is just noise. This is why I'm not getting excited about these recent upgrades. In fact, they're making me more cautious. The fact that we've had 3 price target increases in 2 weeks suggests we might be approaching a sell the news moment. This doesn't change my fundamental thesis on Exxon, but it does inform my tactical approach to dollar cost averaging. Let me share something that could dramatically impact our Exxon strategy. Peter Brandt, one of the most respected technical analysts in the commodities world, has identified a massive descending triangle pattern in crude oil. This isn't just any pattern, it's been forming for months and has profound implications for Exxon. Here's what Brandt is seeing. Oil has been making lower highs while finding support around $62 to $68 per barrel. That's creating this descending triangle pattern. Brandt attempted to buy crude oil at the bottom of this triangle last week, but wasn't filled. He's looking to be more aggressive this coming week if oil tests that $62 support level again. Now, here's the key insight. Brant is looking at this as a swing trade opportunity. He expects oil to bounce between that $62 and $68. That's about 9.7% move. But the longer term implication of this descending triangle is bearish, with targets potentially below $40 if the pattern breaks down. Now, why does this matter for ExxonMobil? For every dollar change in oil price, ExxonMobil's earnings per share changes by about 21 cents. So if Brant's swing trade works and oil bounces from $62 to $68, that's a $1.26 potential boost to ExxonMobil's earnings. Conversely, if the triangle breaks down and oil falls to $40, we're looking at a possible $5.88 earnings per share hit. This is why I'm watching oil's action around that $62 level very closely. It's not just a technical level, it's a fundamental catalyst for ExxonMobil's earnings trajectory. And here is my oil price sensitivity chart that shows the effect of the price of oil per barrel and the impact on ExxonMobil stock. Now let's deep dive into what I believe is the most compelling part of the ExxonMobil investment thesis. And it connects directly to my previous video, Everyone Missed These AI Stocks, where we analyze why ExxonMobil beats Chevron in the AI energy war. Let me show you this specific Seeking Alpha article that was published on July 4th, 2025, titled ExxonMobil Guyana Production About to Grow Roughly 50% by Longclair. This isn't just another oil production story. This is about ExxonMobil's transformation into an AI energy infrastructure play. Here's what the article reveals. ExxonMobil is about to significantly boost Guyana production with the Yellowtail project coming online in August 2025. We're talking about adding 250,000 barrels per day to their current 648,000 barrels per day output. That's a 50% production increase from one of the world's most profitable oil regions. But here's the connection to our AI thesis that most investors are missing. Remember, in my Everyone Missed These AI Stocks video, we discussed how data centers consumed 187 terawatt hours in 2024 and are projected to reach 450 terawatt hours by 2030. Well, this Guyana growth story is Exxon's positioning itself to power that massive energy demand. The article points out that Exxon's management is confident about winning the right of first refusal dispute with Chevron over the Hess acquisition. We went into detail on who we think will win that fight, so please look at that video. If Exxon wins, Exxon gets even more Guyana exposure. If they lose, they still have the largest stake in the most profitable oil development in the world. What makes Guyana so special? The break-even cost is under $35 per barrel, and the current oil price around $68, we're talking about a massive profit margin. The consortium's 2024 profit jumped 64% to $10.4 billion, and Guyana accounted for $4.7 billion of ExxonMobil's total adjusted earnings. Now, let's talk about Morningstar's valuation. Looking at the current Morningstar data, I'm seeing ExxonMobil's fair value estimate at $135 per share. With stock trading around $115, that represents about a 14% discount to fair value. Morningstar gives ExxonMobil a 4-star rating with a narrow economic moat and high uncertainty rating. What's important about Morningstar's analysis is their reasoning. They're not just looking at oil price movements, they're recognizing ExxonMobil's structural advantages. Morningstar specifically notes that Exxon is best positioned among integrated oil firms for a potential downturn, given its underlying earnings growth and strong balance sheet. This ties directly back to our AI energy thesis. ExxonMobil has the scale and financial strength to meet the massive energy infrastructure demands that AI is creating. The key insight here is that while everyone else is focused on quarterly oil price movements, ExxonMobil is building the energy infrastructure that will power the next decade of technological advancement. The Guyana growth story isn't just about oil production, it's about providing the energy security that AI data centers demand. This is why I'm not concerned about temporary oil price volatility. The AI energy demand story is structural and long term, and ExxonMobil's Guyana position gives them a low cost, high margin asset base to capture that demand. At Morningstar's $135 fair value estimate, we're looking at 17% upside from current levels, and that's before considering the impact of this AI energy transition we've discussed in our previous video. Based on all this analysis, here's how I'm modifying my dollar cost averaging strategy, and this is where the rubber meets the road for your portfolio. First, I'm shifting from my current approach of investing every few days to a monthly strategy. Instead of $2,750 every few days, I'm moving to $1,000 to $1,500 monthly purchases. This gives me more flexibility to respond to market conditions while maintaining my systematic approach. Here's my new framework. If ExxonMobil is trading above $110, I'll invest $1,000 monthly. If it drops to the $100 to $110 range, I'll increase to $1,500 monthly. And if we get a significant pullback below $100, which could happen if oil breaks below $62, I'll ramp up to $2,000 monthly. The key catalyst I'm watching is the August 1st earnings report. Remember, ExxonMobil has already warned of that $1.5 billion earnings hit. This could create a buying opportunity if the market overreacts to what's already been telegraphed. I'm also using Peter Brandt's oil analysis as a timing tool. If oil successfully bounces from $62 support level, that's bullish for ExxonMobil's near-term earnings. If oil breaks below $62, I'm prepared to be more aggressive with my purchases because the long-term AI energy thesis remains intact. I'm using systematic dollar cost averaging to build a position and company that's trading at 15 times earning while being positioned to power the AI revolution. The beauty of this approach is that it removes emotion from the equation. Whether oil is at $62 or $68, whether analysts are upgrading or downgrading, I'm consistently building my position in a company that Morningstar values at $135 per share. My target is to build this position over the next 12 to 18 months, allowing me to capture the full cycle of oil price volatility while positioning for the long-term AI energy demand growth. This isn't about timing the market, it's about time in the market with a systematic approach. Here's the bottom line. While everyone else is chasing analyst upgrades and trying to time the market, systematic dollar cost averaging into quality companies like ExxonMobil is where the real money is made. The research proves it, and my results show it. But here's what I want you to remember. ExxonMobil isn't just an oil stock anymore. It's an AI energy infrastructure play hiding in plain sight. While Nvidia trades at 60 times earnings, ExxonMobil trades at just 15 times earnings. Yet, it is positioned to power the entire AI revolution. The descending triangle pattern in crude oil that Peter Brandt identified. That's not a bug, it's a feature. It's going to give us better entry points for a company that Morningstar values at a premium per share where it is trading now. Now, if you found this analysis valuable, I've got something special for you. This month, I released a comprehensive deep dive on why ExxonMobil beat Chevron in the AI energy war. That video broke down the entire investment thesis that's driving my DCA strategy. You can find that link in the description below. If you're serious about building wealth through systematic investing, I just published my complete guide to dollar cost averaging in energy stocks on my Substack. Link below in my description. It covers everything from position sizing to timing strategy. The AI energy revolution is just getting started, and the companies that power it are going to create generational wealth. Make sure you're positioned on the winning side. Check out my other videos. I just recently released a complete breakdown of Bloom Energy, a stock I found using AI, and I am up 20% in 1 month. Until then, keep building those positions systematically.